All right, good morning and welcome to November 2021 monthly market outlook for True Options Masters. We've got Mike Carr and Chad Shoop, and of course, I'm Chris Cimarelli, and we're all excited to talk to you guys today. So guys, before we get started, I do have to give both of you gentlemen a shout out. I made 3 triple-digit gains from your free recommendations here in Tom last month. So Mike, October 1st, you published an article based on the strategy that you used to manage $200 million 10 years ago. And what you do is basically you just highlight your sectors of the month, essentially, kind of what Chad does here in these videos. And you said you were bullish on lithium. So you know what I did, Mike? I just went ahead and I bought a call option that was in the money that expired first day of November. And let me pull this up real quick so I get the number right. So on that, I basically turned a 9% gain in lithium, the lithium ETF, LIT, into a 119% gain. And I did that in about 2 weeks, Mike. So that was really cool. And then Chad, last month in our monthly market outlook, you said to buy utilities. That was your sector to watch this month. And Chad, I basically bought both of these positions at the same time, sold them the same day. Chad, I made 109% on that one. And all I did, again, I just bought a call option. You guys said these sectors are going to go up this month. So I figured, why not buy a call option? Leverage the move. And I made 100% on both of those. And Chad, I also have to give you another shout out. A couple Thursdays ago, in your Bank It or Tank It quick takes videos, you brought us our attention to AMAT. So that's applied materials. And actually it was Michael Merson, our managing editor, who told me, hey, Chad's really bullish on AMAT. So I looked at your article, you persuaded me, I bought a call option, and I cashed out the very next day, 24 hours, for a 132% gain. So let me just address our readers for a quick second here. Guys, if you're not taking advantage of the free recommendations that they're giving you in True Options Masters, you've got to do it. I made 3 triple-digit gains last month. You could have done exactly the same thing. Maybe some of you did exactly the same thing. If you did, we'd love to hear from you. Drop some comments below. And of course, please subscribe to our YouTube channel so you don't miss videos like these in the future. So I know Chad is going to reveal his sector to watch today in this video in just a few minutes. But before we get to that, Mike, I know you just published an article yesterday about your sectors to watch for the month. We were talking about that a little bit just before we jumped on here. So Mike, what are you watching this month? And again, this is the same strategy you used 10 years ago to manage $200 million. So I think this is really interesting and I want us to pay attention.
So this month, what popped up on the buy list was commodities and India. Now, commodities, not a surprise here. If you've gotten gas lately, you probably noticed, I know a lot of our viewers, a lot of us drive bigger vehicles, those trucks, SUVs. It's costing $75 to $100 to fill up.
Yeah, well, now, Chad drives a Porsche and I drive a gas guzzling Mercedes. So we're feeling the pinch there too.
Yeah. And those are small tanks. So you're filling it more often.
Premium.
Yeah, at least we're filling it, once a month. But that's a trend that's going to continue. And just the symbol, DBC, is the ETF that tracks a commodities index. So it doesn't focus on stocks. It uses the actual futures contracts. And it's very heavy in energy because the index is heavy into energy. So it's got exposure to gasoline, crude oil, heating oil. Heating oil is widely used in the northeastern United States in wintertime. And heating oil prices are expected to be up about 50% this winter. Natural gas, which is used to heat most of the rest of the country, could be up even more. The government statistics show it could be 75% or so. Now, I know you're in Florida, so you don't even have heaters. But the rest of the country...
It's November and it's entering the winter months. It is a little bit chilly. I don't start immediately sweating when I walk outside now. So
I just moved to Arizona. It's 80 degrees and I'm really loving it as I look at what the natural gas bill would have been. Although air conditioning is expensive as well. And DBC captures all of that, but it also has exposure to the other commodities, copper, aluminum, zinc. These commodities have all made significant moves, triple digits off their 2020 lows. It has exposure to sugar, the soft markets, as they're called, but food markets. And if you've been to the grocery store, you know food prices are up. So DBC is your kind of one-stop shop to gain exposure to all of those commodities. And it does it without exposing you to the risk of the commodity market. Now, technically, if you buy a commodity futures contract, you can lose much more than you invest. And that's not technically, that's true. If you were to buy, let's say, a treasury bills contract, you might put up $10,000 at your broker. You could lose up to $100,000 or more if there's a big move against you. So futures are definitely not right for most people. However, DBC limits that risk, gives you the exposure. You have the upside with limited downside. Call option, as you know, Chris, gives you leverage. In this case, you're getting leverage on leverage. And that's really an interesting trade there because the commodity futures are leveraged as well. So you're going to have that double kick from call options. Kind of surprising to me, INDA, an ETF with exposure to India, also appeared on the list this month. Now, India is one of those proverbial wait till next year kind of trades. If you're a baseball fan or a football fan, at the end of the season, popular refrain is wait till next year because your team's going to come back. India's in that category. Every year we see a bullish forecast. Every year something happens and they disappoint. So I think this year's their year. This time is different. We are recovering from the pandemic. India was hit hard. GDP contracted about 8%. And now we're going to see kickback growth. And as we see that recovery, we're also seeing a shift away from various countries in the supply chain. Questions coming out about China's reliability as a trading partner. Well, India has a ready-made pool of labor that's available at relatively low cost. Shipping is kind of equivalent to China, so shipping costs kind of equivalent to China. So you could see that shift to India finally occur, and INDA is positioned to benefit from that.
Well, Mike, here's what I'm going to do once we wrap up this call. I'm going to log into my Robinhood account, which I know you hate, and I'm going to buy a call option that expires the first expiration in November. It's going to be in the money on INDA and DBC. So there's the other one.
DBC. Wall Street Journal had a great article on Robinhood. Somehow they make more money off options trades than anything else they do. So go figure.
I could tell you why. I always do limit orders when I trade options on Robinhood. In fact, I find that they often encourage you to. They almost will not let me buy an option without entering a limit order. But yeah, you limit orders are what you want to do when you trade options, especially on Robinhood.
And they even suggest the limit price for you, don't they?
They do.
They're so nice. I wonder if they're making money by upping that a few cents. Anyway, we'll wrap up on Robinhood. And
I try to make my own decisions but practice free will. So, that's very interesting. I've wanted commodities to go up for years because I realized that for years now, they've been trading at a historically low valuation relative to stocks. So I know at some point they've got to come back. And, India at some point, once it gets its momentum, that's going to be a 20, 30-year trade. So I might even go look at and maybe even buying some speculative Indian stocks to hold until I'm 50. I got time. I realize not everyone does. So, okie dokie. So before we get into our main stuff for today, I do want to say, Chad, it is official. We are launching Fast Lane Profits this month. We're so excited. Our target date is November 15th. So middle of the month, we should be going out with it. If you guys want to be first in line to see it, I'm talking to our readers now. If you guys want to be first in line to see it, we do have a link in our description box for you to sign up. And as soon as it's ready for us to launch, you will be first to know. do bear in mind, we are capping our charter members at 500 spots. We've got nearly 100,000 True Options Masters readers now. We can only really open up 500 spots in this right now because we are trading options. There's not room for everybody. Liquidity is good, but it's not infinite. So it's going to be first come, first served. So definitely put your name into that link. It's just a very quick form, and you'll be first to know. Very excited about Fast Lane Profits, Chad, because the stuff that you show in these monthly market outlook videos with your relative rotation graph, we call it your profit radar. You're going to be upping the ante with your proprietary Fast Lane code. And this is something that you created and truly found after months and months and months of research that unlocks the true power of the relative rotation graph.
Yeah. I mean, I'm super excited too. I can't wait, for that day to finally get here. But yeah, I mean, we're taking the same type of graph that we're working on in these monthly outlooks, but yeah, totally different way to use them though, that makes them a lot more profitable in the short term. And instead of these where we're looking at, the sectors and that sort of thing, we're going to break down. It's called Fast Lane for a reason. And, I just make sure you signed up so that way you can get all the details, in a couple of weeks when we release, our special promotion for it.
Yeah, and we call it Fast Lane because every single week you are going to know what the market's Fast Lane is. We break it down to 5 major ETFs on the market: Dow, NASDAQ, SPY, and a couple others. And not only that, we also drill into those index, the Fast Lane, every week. Well, I shouldn't say we, Chad does it. And he tries to find the fastest car every single week. So every week you're going to know the Fast Lane in the market, and you're also going to know the absolute best stock to bet on that week. And Chad's going to be recommending options, of course, but Chad, that alone is exciting me. Just knowing essentially like every single week, you're going to know the best stock to bet on. That's really cool.
Yeah, we're following these stocks that are on the move and expected to make the big gains that week. So yeah, it's really fun. I mean, it's a quick service, but again, it's fun every week. We look into those 2 fast lanes in the market, which once you see how it works and see how these trades come out, it starts to really make sense using this relative rotation graph to kind of spot these opportunities, but we use a variation. So it's not the same graph that I show you today or that we show you in these monthly outlooks. It's a unique code and a unique variation of the graph that helps us spot these fast lanes in the market.
Gotcha. Well, we'll let the video do all the talking when it's out in a couple weeks. So again, just sign up and keep an eye out for that. Very excited to share that with you. So okie dokie, let's get into the meat of today's call. Mike, I'll go ahead and start with you. You usually start with some macro market stuff. And truthfully, I have no idea what you're going to talk about today. So I'm just going to let you take over.
Okay, so I want to share my screen here and show a chart. This is a simple chart we looked at in the past, the S&P 500 with a simple 50-day moving average. And the 50-day moving average, I've been thinking of it as kind of like the piano falling out of the sky indicator. And there's a lot of old movies, Laurel and Hardy, where they look up in the big city and a piano's falling out of the sky, and they stand there and they get hit by it. And I feel like a lot of individual investors watch the piano smash into them so many times. So the 50-day moving average is just tell you the piano's falling. When the piano's falling, get out of the way. Don't be aggressive. Maybe buy a put option. Maybe just stop adding new money to the market, but take the warning and don't get hit in the head. And I think that many of us, just the market hits us in the head over and over again. And the 50-day moving average just might be a way to avoid that pain, because it's not as funny when it happens in real life as it is when Laurel and Hardy did it. So since last month I talked about the bullish divergence that was forming in the peak velocity timing tool. And that did resolve to the upside. So when we see a divergence like that, price falling, momentum rising, we expect price to rise. Price did in fact rise. And once we broke above that 50-day moving average, very quick move, pretty much as expected. That's history. Looking forward, we're still above the 50-day. The 50-day is rising, so it's moving towards the market action now. Momentum slowing, that's to be expected after the sharp rally that we saw. But momentum it can rally up again. We have an awful lot of money on the sidelines, and I think that can move into the market. So what I'd like to do is look at where all that money is sitting right now. And I want to look at the gross domestic product report that came out last week. We always want to look at economic data. GDP for years was right near its trend line. And not to be political, but the dips below and the rallies above did coincide with different presidential terms. There was something different between 2008 and 2016 than there was from 2016 to 2020. And it's the nature of regulation. So when the regulatory environment was suitable, the economy raced ahead and went way above its trend line. We're now back to that level. The regulatory environment may not be the same in 2021 and 2022 as it was in 2019. There's some differences in Washington between then and now. So we're probably going to see GDP come back towards this trend line a little bit. That's not necessarily bad news. I know GDP grew 2% last quarter, lots of headlines about woe is me. It's not really that bad. 2% is where we were during most of the 2000s. Stock market can do well in that environment. The big concern was with consumer spending. Consumer spending grew less than expected. Here's consumer spending with its trend line. Consumer spending was rising above its trend line heading into the pandemic, and it got distorted. It's going to return towards its trend line, but it's $1 trillion above trend. As consumer spending reverts towards trend, it's still going to be $500 billion, $250 billion above trend. That's 2% GDP growth right there. So even as consumers spend less, they're still spending much, much more than they were before the recession. We're kind of at a permanently higher plateau in personal consumption expenditures. This is the data the Fed watches closely. So the Fed's seeing a healthy economy, and they're right this time. I think you're going to see the Fed taper. Market may dip on the news and then rally strongly as everyone realizes the Fed is tapering because the economy and the consumer is very strong. That's it.
That's a huge move. It just completely almost seems like it overcorrected from the drop last March.
It seems that way, but I'm detailing on Money and Markets today, Wednesday, that shows consumers still have $3.5 trillion in excess spending to do. This dip was so sharp that we have not recovered from it fully just yet. We're still about $3.5 trillion. I expect that to be spread out over the next 18 to 24 months. So you're going to see extra spending of about $200 billion or so per month for the next year or so. And that's just going to propel stocks in particular, because they're going to spend money. The companies in the S&P 500 and other publicly traded stocks are going to generate sales, and they're going to earn higher than average profits based on all of that excess capital.
Do you think any of the issues we've seen in the global supply chain and maybe even semiconductor shortage could interfere with that, just due to, lack of supply and things for people to buy?
It's deferring maybe some sales. If you want a new car, you may have to wait 12 weeks instead of 2.
Sure.
But you're still going to buy the car.
Yeah. Wow. Okay. So what does this all mean, Mike? Buy S&P 500, hold on for the next year?
Yeah, absolutely. It looks very bullish for stocks when you have this kind of trend in consumer spending, because we're going to draw closer to that line, but that line is also rising. So We have a lot of excess cash on the sidelines. Consumers, even if they do say there's nothing to buy, I don't know what to do with my cash, they're going to realize, oh, wait, I can go to Robinhood and put it in the stock market. So no matter what, we're going to see cash move from the sidelines and push stocks higher.
Okay, well, it's very exciting. And Mike, I know you have your 11,000 target for the S&P 500 for 2024. You're predicting it to double over the next 2 years, nothing crazy. So this definitely looks like it fits into that theme.
It does.
Okay, well, thank you very much, Mike. All right, Chad, it's your turn. We'll turn it over to you, buddy.
All right, so back to the RRG. So thanks for that big outlook, Mike. That's, I love hearing how bullish you are. And I mean, I don't have to pull up the chart on the S&P 500, but they recently hit new all-time highs. That's always a bullish sign. So just seeing the market hit that, it's not a sign to sell. It's a sign to still be kind of cautiously optimistic, maybe right here when the Fed makes some news this week. Could get a small dip, but overall, it's time to be bullish in the stock market. So the relative rotation graph, we go through this every month, but just a quick recap that on the center of this chart is the S&P 500. So that's our comparison index. And we have all the indexes that make up the S&P 500 rotating around it. And when they're in the upper right, they're leading the green quadrant. When they're in the bottom right, they're weakening. The bottom left, they're lagging. And the top left, they're improving. But when we scroll through when we scroll through, there we go, how they rotate through, they tend to rotate clockwise and go through all the quadrants, typically hitting each one. So when we find the biggest moves is when we pick them up in the lagging quadrant, and then they swing all the way to leading. That's when the biggest returns are found. Not once they're leading, then the returns are slower because then they start to weaken and fall from there. So it's kind of counterintuitive to how you can kind of view this chart. So what we do every month is we try to find these stocks that are starting to turn. So this is last month, and these are the indexes, but we had the utility sector. It's this green one down here, XLU. So it was starting to turn. So last month, this was the index that we were expecting to head higher. And it basically did just that. Over here on the right, you can see this is the XLU ETF price chart. And this little yellow line, if you can see it, is the day that we had our video. So we were down here, it made a nice little run higher. I mean, for a utilities ETF, it went up 3, almost 4%. So that's a pretty good move for utilities in those stocks. And you can see on the RRG, as we scroll through it, that utility sector started to make that move and then turned down early, and then kind of got choppy through here. So it wasn't even a good clean move to the leading quadrant, and we still saw some of the bullish moves in the stocks. So the stocks that we had,
I sold my call in the middle of the month.
Yeah, it's a good call because they got that kind of short-term move. This is AEP, one of the stocks that came up. So again, from the 4th down here, it's heading in the right direction, even though these stocks didn't really break out. But like you made some money on these just because of these small moves. You're still able to make triple-digit gains. And they're utility companies, so they typically they're not the most volatile stocks to begin with. At least some of these were, but at least in general, utility stocks, you tend to think of more conservative price moves. So those were the ones that we jumped into last week. But then in the middle of the month, you were talking about AMAT. That was actually based on the relative rotation graph. We wrote about it because the tech stocks were starting to move higher. And I think it was the 21st I had pulled up that I sent this out because I wanted you to take a look at them. And by now, tech sector had already ran up a little bit, but I just wanted to put it on your radar because it wouldn't be available by the time we were doing this monthly outlook. And here where AMAT started to make some quick moves, they're still up today. So they're still made some bullish moves from there. And this is all just based on the relative rotation graph and kind of the background. And we've had success in our other months, more so than this one. But this month, as we go to today, when we're looking at this, November 1st anyways, the index that we want to look at is consumer staples. So this is in the lagging quadrant. It's at the perfect time, turning higher. So this is exactly what we wanted to find. And it's coming up right now as we take a look at it on this monthly chart. And then from here, we dive into the consumer staples. We basically break out all the stocks inside of it and make them relative to the consumer staples ETF. So we put the XLP, that's the center. And now we can see all the stocks that are within the ETF, how they rotate around it at the time. And we want to do the same thing here. We want to find stocks that are down here in this kind of lagging area, headed higher to make this run up. So the 3 stocks that I want to have on our radar today, I was looking at Clorox, but that thing jumped 5% this morning on earnings. So it's already on the move and kind of making its way up there. But I do like Kellogg, the way that it's already turned towards this direction, towards the leading quadrant, basically. Like it's not like we see ConAgra Brands, it's still just kind of drifting to the side. We want to see them start to at least have this turn. So Kellogg's got a nice turn. So that's one stock that you can have on your radar. Monster Beverage, it's definitely a volatile stock because the further we go out on the left, away from the center, basically, the more volatility that we see in these companies. That's what this distance from the center means, that we're seeing bigger price moves. So the further we go out over here, Monster Beverage, we're expecting to see some big moves in that stock. And it's one that you want to have on your radar now because it's already in the improving quadrant, but you can just see if it just makes this big move up here to leading, it's still going to take a couple of weeks that it's going to head in the right direction for us. And then the other stock that we want to have on here, we'll do Campbell Soup, because it's kind of had this long, slower turn here, turning higher. So these are consumer staples, nothing exciting about these companies. Campbell Soup, Kellogg's. This one, Molson Coors, you can also have on your radar because they're all in this rotation and in the right spot. And again, this goes back to consumer staples sector is making the same move. So as long as that plays out and that continues to head higher, and we see one actually go from lagging all the way to leading, like we saw the utility sector turn around early, and we were still able to make some money, but it didn't make it all the way to leading. It didn't have that big move higher. So hopefully this consumer staples sector, we're picking it up at the right time with this month, that it's just definitely the index that you want to have exposure to. And these are the stocks that you want to keep an eye on. So that's kind of all I have for today. I just wanted to run through this. But Chris, did I miss anything as far as kind of quickly explaining the relative rotation graph again and looking at these stocks?
I think we're good. I mean, just to recap, red is bad, green is good. When it's going towards green, in between there, it's the blue, it's improving. That yellow is, again, it's what a yellow at a traffic light looks like. It's looking time to almost stop. What you looking at now here?
So I just put up Monster Beverage real quick, just to, because we look at these a couple of times because they're, so you see that it's in the, sorry, let's split that up, but you see that it's in the improving quadrant down here relative to the consumer staples. So we know it's already improving relative to those stocks, but in the relative to the S&P 500, these shades up here, it's still lagging because it's still red. So it's kind of flatlined. It hasn't even done much, but the fact that consumer staples sector, it's probably been a little weak. This is holding more steady. So it's just showing that this is a strong stock in the sector that's been beaten up a little bit, and now we're expecting it to run higher.
Right. So relative to XLP, it's an improving. Relative to the S&P 500, it is still lagging. So Chad, I'm going to be bullish this month on beer, on energy drinks, on soup, and cereal. And it sounds like a party. So
it does. I mean, you go to these stores and maybe there's something about the pricing here. It's just 1 month, but I mean, I know that everybody I talk to is like, stock your shelves today, because there's, staffing issues, there's trucking issues, there's all sorts of issues, I guess, about getting goods out. They're saying it about Christmas items, but then when I go to Costco just to get, my water, my toilet paper, and my paper towels, their shelves are empty. They have none of this stuff. So I don't know if it plays into what we're seeing on this chart or what, but over the next month, those are the areas to be bullish in.
So Chad, if I was going a little less risky, I might play Monster and I might play Kellogg. If I wanted to go mid-risk, I might do Campbell Soup. And if I wanted to just go for it, I would go for beer. For
beer. Yeah, that's a big move for TAP.
That's the one, honestly, my eyes went right to that one when you pulled up the chart. But again, I'm a young buck. I don't mind taking on risk and taking big swings. In fact, I enjoy it. So TAP's probably the one I'm going to play. And I might drink a beer while I'm doing it. But
just make sure it's a Coors.
Just make sure it's a Coors. Hey, of Coors Light, as far as light beers go, I think it's definitely one of the better ones.
Just got to support the brand.
Absolutely. Well, when the COVID pandemic happened last year, I was chugging Coronas and I got sick of them really quick. I got to tell you.
Time to change it up.
I haven't been able to drink one since. I just got so tired of drinking that stuff.
Well, at least you got a pandemic story to share.
Yes, indeed.
Can't drink Corona.
Hey, just a little fun fact here. Over the last 25 years, Monster has been up an average of 38% a year. Apple has been up 29%. Wow. Monster is the best stock over the past 25 years. I make energy drinks.
When we launched a service for Palm and Pilly last year, 100X Club, and that was the stock we highlighted more than any other. That stock just absolutely went higher. And the point there was buy niche companies when they're early and when they're starting to grow, because niche companies like that, they can absolutely skyrocket. So guys, here's what I'm going to do. I'm going to buy calls on INDA, on DBC, on XLP, and I might even buy calls on TAP. And this time next month, we'll review how I did. Readers, you guys are welcome to join me. Again, we create this content for you. We give you all these free trade ideas so that you could succeed in the stock market. I'm taking advantage of it. Nothing's stopping you from doing it too. And my hope is that you make so much money from our free trade recommendations that you're gonna be begging us to sign up for Mike and Chad's premium research, where they can really just knock the cover off. So I think that's all for this month. Gentlemen, again, thank you for your time. And thank you, dear readers, for tuning in, and we'll talk next time.